Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on Friday, July 21st, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's get to that. We've got a lot to unpack tonight, from a $1 billion lawsuit against FTX's former executives to a hacking incident involving Uniswap's Twitter account. We'll also be discussing a new crypto bill proposed by House Republicans, the UK's new Prudential rules for crypto firms, and the launch of Indonesia's digital asset stock market. And if that's not enough, we'll be diving into the latest developments in central bank digital currencies with a look at France. So buckle up, because it's going to be quite the ride. FTX has taken legal action against its former executives, including Sam Bankman-Fried, Caroline Ellison, Gary Wang, and Nishad Singh. The company is seeking to recover a whopping $1 billion, alleging these individuals misused funds in a very big way. The lawsuit claims these former executives were living large on customer funds, using the money to finance luxury condos, political contributions, speculative investments, and other personal projects. They're accused of creating an environment where a few employees had almost unlimited power to oversee transfers of fiat and crypto assets with no effective oversight. The lawsuit also alleges these former executives issued more than $725 million of equity to themselves without the company receiving any value in exchange. Bankman-Fried and Wang are accused of misappropriating an additional $546 million to purchase shares in Robinhood. Ellison is said to have paid herself $28.8 million in bonuses and used $10 million of funds to purchase a stake in an artificial intelligence company. The lawsuit also alleges that Bankman-Fried's father is funding his son's legal defense through an illegal loan from the company. It's claimed that Bankman-Fried transferred $10 million of FTX US funds into a personal account of his on the platform, then 1 minute later sent that amount to an FTX account under his father's name. His father then allegedly transferred nearly $7 million to his personal accounts at Morgan Stanley and TD Ameritrade. In another twist, Sam Bankman-Fried's younger brother, Gabriel, is said to have outlined a plan to purchase a sovereign nation microstate within Micronesia, reportedly in order to create a haven for believers in effective altruism. The younger Bankman-Fried also mused about using the sovereign nation to create a lab for experiments in human genetics. The U.S. Department of Justice also accused Bankman-Fried of leaking the private diary of Caroline Ellison to the New York Times. The attorneys argue that an order restricting speech outside of court is necessary. This is because of the intense media attention the case has received. Additionally, the defendant has been attempting to manipulate media coverage to his advantage. Before we move on to our next story, don't forget to like, follow, and subscribe to stay updated with all the latest news. Now, let's talk about Uniswap's recent Twitter hack, a stark reminder of the risks in the crypto world. Hayden Adams is the founder of Uniswap. He found himself in a bit of a pickle recently. His Twitter account, followed by over 254,000 crypto enthusiasts, was hacked. The hacker or hackers did not waste time. They started tweeting out a malicious link, claiming that Uniswap's Permit 2 contract had been hit by an unknown exploit. They said users' tokens were at risk and urged them to click on the link. The first scam tweet didn't last long. It was taken down within minutes. But the hackers were persistent. They kept posting nearly identical tweets. Some of these tweets were still visible to Twitter users at the time of the incident. The Uniswap Foundation was quick to respond. They warned everyone not to click on any links. They assured users that there was no giveaway, airdrop, or bounty. They also confirmed that the protocol had not been hacked or exploited. Scams like this are nothing new in the world of crypto. Bad actors often use social media platforms to trick users into parting with their crypto assets or fiat money. But the companies behind these platforms are starting to fight back. Twitter, for example, has been limiting the number of posts a user can read daily. They said this is part of their effort to detect and eliminate bots and other bad actors. Meanwhile, Meta launched a new microblogging app called Threads. It's expected to rival Twitter, but within days of its launch, scammers promoting fake NFT projects and impersonating crypto Twitter personalities had already infiltrated the platform. This is a reminder of the risks involved in crypto. It is a wild west out there, folks, and while freedom and decentralization of crypto are what draw many of us in, they also make it a prime target for scammers. So stay vigilant, always double check before clicking on any links, and remember, if something sounds too good to be true, it probably is. From the digital world to the world of politics, let's discuss a new crypto bill proposed by House Republicans that could significantly change the crypto markets in the US. Senior House Republicans have put forward a bill that could shake up the crypto markets in the US. This bill, over 200 pages long, is called the Financial Innovation and Technology for the 21st Century Act, which is quite the mouthful. What it means for us is that the SEC and the CFTC would have to create rules specifically for digital asset trading platforms and exchanges. Now, here's the kicker. The regulators would be barred from making rules about how individuals like you and me can hold assets. That's right, folks. No government meddling in your wallet. The bill also proposes some changes for digital asset projects. They could be exempt from the usual restrictions for securities offerings up to a certain limit. Issuers could offer up to $75 million worth of tokens in a year, but there are some restrictions. Most of these restrictions are on sales to unaccredited investors, which, let's be honest, is most of us. Now let's get into the nitty-gritty. This bill also includes language that explicitly prohibits the mixing of customer assets, which is kind of a big deal, folks, because that's a charge that's been leveled against some of the biggest players in the crypto world. The bill also sets some requirements for token issuers. They would have to limit purchases to 5% or less of an individual's annual income or their net worth, whichever's greater. And no matter how much money you've got, an issuer could not sell more than 10% of their tokens to any one buyer. This bill is kind of a big deal. It's a sign that the government is starting to take cryptocurrencies seriously. But it's not all smooth sailing. The bill is set to be debated and voted on in the House of Representatives next week. It's unclear whether it will get enough support from Democrats to become law. But here's the thing. Even if it fails, this bill is still a step in the right direction. It's a sign that the government is starting to take crypto seriously, and that's something we can all get behind. And while you're hitting that subscribe button, let's cross the pond to the UK, where the Financial Conduct Authority is planning to implement prudential requirements for crypto firms. The FCA in the UK is cooking up something new. They're designing prudential requirements for firms that are involved in crypto. Now, if you're wondering what prudential requirements are, they're basically rules that help ensure firms have enough capital and are managing risks appropriately to protect investors. The FCA is the one keeping a list of crypto firms that have gotten the green light to operate in the UK under their anti-money laundering rules. They said that they'll also be consulting on these new rules for crypto companies once they get the go-ahead from the Treasury and the Parliament. As of now, there's no word on when they'll receive these regulatory powers. The FCA isn't new to this game. They already have a similar system in place for investment firms like fund managers, asset managers, and trading firms based in the UK. These firms have to assess their capital adequacy and risk to identify potential harm to investors and provide appropriate resources to mitigate that harm. Last year, the FCA sent out notices to firms that have dealings with crypto companies. They urged these firms to have proper systems and controls in place to counter the risk of being misused for financial crime. They also asked the firms to review whether the companies they work with are registered crypto companies. Now let's look at the bigger picture here. The FCA was recently granted a bunch of new powers under a financial markets bill that was passed. This puts them in a position to be the UK's main crypto watchdog. The UK does have ambitions to become a global hub for the crypto sector, and it seems like the FCA is going to play a key role in that. But let's not forget, while these regulations might seem like they're for our protection, they're also a way for governments to keep a close eye on the crypto industry. It's a delicate balance between ensuring investor protection and maintaining the freedom and innovation that we love about crypto. So, sure, let's embrace the opportunities, but also question the motives of those in power. After all, it's our enthusiasm that's driving this industry forward, and it's our healthy skepticism of governments and central banks that will keep them in check. Don't forget to hit that like button if you're enjoying the show. Now, let's celebrate the launch of Indonesia's digital asset stock market, a significant step forward for the country's crypto industry. Indonesia has finally launched its digital asset stock market and clearinghouse. This has been a long time coming, with lots of delays. The government had hoped to get this up and running by the end of 2021, but it's been a bumpy road. The most recent delay was in February, but now it is here. This isn't just a win for crypto enthusiasts. It's a sign that the Indonesian government is stepping up. They're creating a fair and just trading ecosystem for crypto assets. They're providing legal certainty and protection for the public. The Indonesian Commodity Futures Trading Supervisory Authority, BPPT, confirmed this in a press statement. And BPPT isn't going it alone. They're working with the Financial Services Authority, the Central Bank, and the Ministry of Finance. The goal is to keep the local industry running smoothly and to reduce crypto-related risks. Indonesia is quickly becoming a major player in the crypto world. The government isn't just tolerating crypto, they're actively promoting it. They see the potential benefits for the local economy and for Indonesia's standing in the global market. I sure would like to import some of that. But let's not forget, folks, this is still a government operation. They're working with the central bank and the Ministry of Finance. So while it's great to see a national crypto exchange, we have to remember the institutions involved. The government's involvement could be a double-edged sword. On the one hand, it provides legal certainty and public protection. On the other hand, it could lead to more regulation and control. So while we do celebrate this milestone, stay vigilant. Keep pushing for a world that's free from excessive government control and central bank interference. Because that's the true spirit of crypto, isn't it? Freedom, independence, and the power to control one's own financial destiny. Now, before we move on to our last story, remember to follow us for more exciting news from the world of crypto. Let's delve into the world of central bank digital currencies with a focus on France's experiments with a wholesale CBDC. And France is our newest CBDC Alert. The French central bank has been busy. They've been testing a wholesale central bank digital currency. They're saying that it could make cross-border payments better. They also believe it could make settling financial assets more secure. And guess what? They're using the same kind of technology that powers cryptocurrencies to do these tests. So they've been at this since March of 2020. So far, they've done 12 experiments. One of these is settling a bond worth 100 million euros with Luxembourg. They've also been working with the Monetary Authority of Singapore, the Swiss National Bank, and the Innovation Hub of the Bank for International Settlements. The French central bank thinks a wholesale CBDC could be a game changer for digital assets and tokenized assets. These are assets that aren't listed and can't be settled right now. Central banks all over the world are doing similar experiments. The Bank for International Settlements is leading many of these. India started doing its own testing, and the European Central Bank plans to start in 2024. The French central bank says it will support Europe's work in this area. Now, the French central bank thinks a wholesale CBDC could work well with a retail CBDC like a digital euro. They're talking about making data exchange seamless, working together internationally, and partnering with the private sector. They want a global CBDC framework that includes everyone. They're also saying they need to think about the environment. They want to make sure wholesale CBDCs are energy efficient. Now, isn't that interesting? The same folks who've been criticizing cryptocurrencies for their energy use now say they need to make their own digital currencies energy efficient. So at least they're somewhat consistent. So what do we make of all this? It's clear that central banks are keen on digital currencies. But remember, these are the same institutions that control traditional money. They're not exactly known for their love of decentralization. And yet, they're using technology that's all about decentralization. It's kind of like a wolf in sheep's clothing, isn't it? And let's not forget, these are the same folks who have been warning us about the dangers of cryptocurrencies. And now they're jumping on the bandwagon themselves. It's a bit much, right? In the end, it's up to us, the people, to decide what kind of money we want to use. Do we trust these central banks with their digital currencies? Or do we stick with cryptocurrencies, which are by the people, for the people? It's a big question, and one that we'll be watching closely. So what happened? We started with FTX's billion-dollar lawsuit against its former executives, a saga filled with allegations of misuse of funds and a plot to buy a sovereign island. We then moved on to the hacking of Uniswap's Twitter account, a reminder of the risks in the crypto world. In legislative news, we discussed a new bill proposed by House Republicans that could significantly change the crypto markets in the US, and the UK's FCA plans to implement prudential requirements for crypto firms. We also celebrated the launch of Indonesia's digital asset stock market, a significant step forward for the country's crypto industry. Finally, we delved into the world of central bank digital currencies, with a focus on France's experiments with a wholesale CBDC. It's clear that central banks are keen on digital currencies, but we must remain vigilant and question their motives. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we will see you tomorrow night.